Most people think that once they get their offer on a house accepted, it's smooth sailing, an easy jaunt to the finish line. But what if I told you escrow isn't just a victory lap? What if I told you it's the one part of the process where you can lose the most money in a transaction and still lose the house you thought you won? And here's the part most buyers don't hear until they're already in it. In the first 72 hours, there are two considerations where, if not handled correctly, can cost you tens of thousands of dollars. And there's one moment in that first 72 that can literally make your deposit disappear before you know it. I won't hide the pickle. That last one is a wiring trap that's got an even smart buyer scam. If you ever get revised wiring instructions, that's usually not an update, that's a red flag. I'll show you exactly how to verify it in a minute. But the bigger issue is leverage. If you don't understand how contingencies actually get removed and what it truly means in Bay Area cities like Oakland, Berkeley, El Cerrito, and more, you can accidentally give up your outs before you're ready and cost yourself a lot of money. By the way, I'm Derek Tyler with the Letterer team at Red Oak Realty. I'm a former attorney and 13-year top-producing East Bay agent. My team and I have helped hundreds of buyers navigate the complex Bay Area buying process. In part 4 of my buyer's guide, I'll tell you how I advise my clients so they don't lose money in escrow and how you can avoid that too. I'll also walk you through the 10-part process from offer accepted to keys. The goal is simple. You move through escrow calm, prepared, and drama-free, with no surprises. So at the beginning, after we do a little happy dance, we launch into escrow mode. If I'm your agent in this scenario, the first thing I do is let my office and transaction coordination team know that we're in contract. I'll send a copy of the contract to your lender and a copy to the title and escrow company and introduce them to one another. I'll also send you an escrow calendar outlining all the important dates and events. The first important date and event to you is you getting the deposit into the title and escrow company. You can wire these funds after you receive wiring instructions from the title and escrow company, but be careful of the scam I mentioned earlier. There are bad actors attempting to intercept deposits out there. Don't forget that revised wiring instructions are a huge red flag. So how do you avoid getting scammed? There are two ways. One, most title and escrow companies will accept a personal check for your initial deposit. You can hand deliver your check to their office or another branch with the escrow number written on it. Second, if you decide to wire, always make sure you call the actual title company and verify the wiring instructions before sending the funds. From the lender, you'll receive initial disclosures. These are a set of legally required documents that provide borrowers with an upfront overview of a mortgage's estimated terms, costs, and other important information. Once these are delivered to you and you acknowledge receipt, the lender can order the appraisal. Now, I mentioned a second consideration within the first 72 hours that can cost you tens of thousands of dollars. While it has a lot to do with the deposit, it has more to do with another part of the process I'll discuss in just a few minutes. Part 2, inspections. Next, if we have an inspection period, we then schedule and conduct our inspection. Sometimes even before our offer is accepted, I'll schedule inspections ahead of time that would fall within our proposed inspection period with inspectors that I know are difficult to book. That way, we can submit an offer with a shorter inspection period, be more competitive, and get them done faster. These inspections can include home inspections, structural pest inspections, and more. Or obtaining estimates from contractors to repair items we know need repair or replacement from the home inspection the seller already provided. A good example here is getting an assessment and estimate to repair or replace a portion of foundation. This could be a large enough bid that it may make you decide against purchasing a home or cause you to renegotiate the price or negotiate for a credit. I always suggest my buyers be present for inspections so they can ask questions and get a personal understanding of the assessment. Sometimes something can sound awful in writing, but not be so bad when told in person and with the ability to see it for yourself. The opposite of that can be true as well. It's also a great opportunity to ask inspectors the questions of, if you were in my shoes, would you do this? Would you be concerned about that? Would you address this right away? Or could that be backburnered for a little bit? That's information that won't show up in any written report, but can be the most useful information you get out of an inspection. Part 3, the appraisal. In part 2 of this video series, I go into depth on what an actual appraisal is and what the contingency is. You can click the card above to check that out. For our purposes here, it's a bit like another inspection, but very light. Usually they do a measurement to get their own square footage number, check for smoke and carbon monoxide detectors, and to see if the water heater is braced and double strapped. A good pair of agents will make sure all of those things are done and in place by the time the appraisal occurs. I like to be present and deliver comps to support the contract price. Unlike with condition inspections, I usually recommend only one of the agents be present for this. Sometimes the appraiser prefers no one is there because they just want to get in and and do their own thing, or they're squeezing us into their tight schedule and they can't give a specific time that they'll be there for an agent to meet them. Part 4, the loan. Usually there are two types of loan approvals in escrow: conditional loan approval and full loan approval / clear to close. Conditional loan approval means the underwriter has reviewed your file and has approved you so long as a few other things happen. Those things could be as simple as supplying updated pay stubs or verification of employment, but they could be more complicated, like cleaning up a negative reporting on your credit report. Some buyers and lenders are okay with moving their loan contingency upon conditional approval when the conditions are easily met. In contrast, full loan approval or clear to close signifies that all conditions have been met, your loan is fully underwritten, and you can proceed with the closing. The key difference is that conditional approval is not final and requires further action, while full approval is the final step before closing. Part 5. Removing a contingency. The inspections, appraisals, and loans, when tied to contingencies, have timeframes. What happens when you hit a date a contingency is due by? Well, if you're ready to do so, meaning you've either negotiated an acceptable credit or price reduction, the appraisal came in at value, or you have underwriter approval, then it's time to remove that contingency. It's important to note that contingency removals in the Bay Area are active removals, meaning you have them until you actively, by sending a contingency removal form, remove them. The form looks something like this on the screen here. It's usually at this point removal time, where if we're negotiating, we kick those negotiations off. If we're making a request, I usually put together a letter outlining the inspections we did, what the findings were, and the cost of repair or replacing the items we found to have issues. Usually, if we're making a request, it's because we learned of an issue or cost that was not previously disclosed by the seller. So I make sure that I outline that as well. I then include a contingency removal, whether it be the inspection, appraisal, or whatever it is that we're removing, that is subject to either an addendum or request for repairs. This is the formal way I generally kick off negotiations. When making a request, you can generally ask for 3 things. 1, a price reduction. 2, a credit towards your closing costs. Or 3, for the seller to make the repair. Let's say during your inspection period, you find out that the roof is leaking. Maybe it was raining during your inspection, because inspectors usually don't hit the roof with a water hose to find a leak. If you obtained an estimate for repairs, say $5,000, or replacement of the roof, let's say $15,000, assuming that it's beyond estimated life in this example, then you have options. You could ask for a $5,000 or $15,000 price reduction. You could ask for a $5,000 or $15,000 credit towards your closing costs. This would not change the purchase price, but it would change the amount of money the seller received from the sale. That $5,000 or $15,000, instead of going to the seller, would go to you to cover some of the closing costs you would have otherwise had to bring cash to cover. This frees up your cash to make the necessary repairs yourself. Lastly, you could ask for the seller to make the roof repair or get the roof replaced. I generally dislike this option the most. While it's nice to not have to worry about doing the work yourself, you do have to rely on a seller who will have no more ties to the house to make repairs or replace the roof. They're generally going to be looking for the cheapest way to satisfy you, and that may not always be the best way to handle the situation. And if their work isn't up to snuff, then you have a back and forth about it that can delay escrow when you could have just asked for the money to hire someone to do a good job yourself. Of course, you don't have to ask for the full amount. You could ask for less if you feel like that's more fair. Maybe in this hypothetical scenario we've been going through, you ask for the full cost of repairs to the roof, but not the full cost of a new roof. Our housing stock is old, so in our market, it's not reasonable or common to expect a brand new roof on a house, but it is common and reasonable to expect one that doesn't leak, especially if that wasn't disclosed to you. Speaking of full amounts, if you want my full buyer's guide, you can click the link in the description below or text guide 1 to the number on the screen below, and I'll send the exact guide and checklist I use with my clients. Before I get on to the next part, there's something vitally important I need to share with you about contingency removals. It's also that second consideration within the first 72 hours that can cost you tens of thousands of dollars. Once contingencies are removed, your deposit, that thing due within 72 hours, is at risk if you decide to back out or cancel the contract based on a contingency you've already removed. That means you could lose it to the seller. So make sure you are fully satisfied with your inspections and whatever amounts you've negotiated, that your insurance is in line, the appraisal is in at value with no outstanding conditions, and your loan is fully approved before removing those contingencies, or else you could be out tens of thousands of dollars by losing your deposit. Now, Just because contingencies are removed doesn't mean you're in the clear. Later in the don't section, I have 3 important tips that can keep you from delaying your close of escrow, living in your mom's basement for a few weeks, or just completely torpedoing your deal with no contingencies to keep your deposit safe. Part 6, the closing disclosure. The closing disclosure, or CD, arrives to you around 1 week before closing from the lender. It's a standardized document required by statute that outlines the final terms and costs of your loan, including but not limited to the loan amount, interest rate, monthly payments, and closing costs. It's required to provide transparency to borrowers by providing a detailed breakdown of the loan's terms and costs, and it allows you 3 days to review, understand, and point out any changes, corrections, or discrepancies in the final figures before signing the loan documents. The CD is important not only because of that, but because it must be provided and you must acknowledge receipt of it at least 3 business days before you can sign loan and closing documents with the notary. Acknowledging receipt is not approval of the numbers and the disclosure. It's just indicating that you have received them, and it starts that 3-day clock. This means that if you do have an issue with the CD, you still want to acknowledge receipt and then reach out to the lender regarding the issues. Part 7, signing. This is when you sign all of the lender and title documents. Unfortunately, they do not accept e-signatures, as both the underwriter and most counties require wet signatures on the respective documents. This means that these signings are done in person. After COVID, most signings are now done with mobile notaries at a location of your choosing, either your house, your agent's office, your friend's backyard, etc. They can pretty much meet you anywhere at your convenience. A mobile notary usually costs somewhere between $150 and $250 towards your closing costs. Most title and escrow companies still allow in-person signings at their office, but they generally have to take place during office hours. Part 8, the final walkthrough. In the contract, it states that you're entitled to a final walkthrough to ensure the property is generally in the same condition as it was when you wrote your offer. Final walkthroughs are to take place within 5 days of the close of escrow. They also give you an opportunity to see the home without the staging. I sometimes do this right after the in-person signing if the signing is within that time window. There's a form you will sign called the verification of property condition, indicating that you've done the final walkthrough or waived it. If something is different, wrong, broken, damaged, it doesn't necessarily allow you to cancel the escrow, but it does allow you to delay closing until the issue is resolved. Part 9, down payment. You will receive an estimated closing statement from the title and escrow company right around the day of the in-person signing, indicating the amount of funds that you will need to bring to title and escrow in order to close. This amount includes the remainder of the down payment and your closing costs. Part 10. Closing. Closing is a 2-part process that involves the lender sending funds to title and escrow, funding, and recording the new title with the county. Recording. Usually the lender funds the day before recording, but both can happen on the same day if the lender gets the funds into the title and escrow company early enough in the day. Once all funds are into the title and escrow company, they send the file off to be recorded with the county clerk's office. Once they confirm the file has been recorded, you can get the keys and the house will officially be yours. Now to the don't section. Number 1, don't hold up your escrow by asking why the underwriter needs certain documents from you. Their requests can seem frustrating. You may get a request for one thing, which yields a request for another related document, and you ask yourself, why didn't they just ask for both at the same time in the first place? Doing this, asking these questions, having this back and forth, can delay the close of escrow. I always like to warn people ahead of time because often the request is coming from the underwriter seeking an explanation for something in one or more documents you produced, and after the housing crisis and new regulations, they have to verify and explain everything in their files. Knowing this ahead of time should make the process just a little bit easier and less painful. If you're renting, don't give notice to your landlord that you're moving out too early. Let's say you give 30 days notice to your landlord that you're moving out, and on day 14 of your escrow, you find out that the loan is just not going to go through, and you have to cancel the escrow. You might be out of a place to live in 16 more days and end up living in your mom's basement.
Hey, Mom! The meatloaf!
You can avoid this by waiting to give notice until you've removed all of your contingencies. That's when you know with a good amount of certainty that your transaction is going through. While this may mean some overlap between new house and rental, it's worth it to avoid your mom's basement.
Meatloaf!
The overlap may also allow you to have a more relaxed move where you're not scrambling to get everything out of your old house and into your new house on the same day. My third don't do anything to affect your credit during escrow. I know it's an exciting time and a lot of changes happening, but don't change your credit score by getting a new Wayfair or Macy's or Home Depot credit card to buy furniture or supplies just yet. Lenders will do a final credit check during the escrow, and if there's a change, it can completely torpedo your deal at a point where you no longer have any contingencies to bail you out. So hold your horses. You can always apply for that card, buy that boat, or lease that electric car after escrow. So quick recap. Part 4 was about navigating escrow from day 1 to keys, deposit and wiring, inspections, appraisal, loan approvals, contingency removals, the closing disclosure, signing with the notary, final walkthrough, bringing in funds, and recording. If you found this video helpful, please like and subscribe and hit the bell icon for notifications of when new videos drop on the channel. Grab the buyer process guide from the link in the description or text guide 1 to the number on the screen now, and I'll send it right to you. If someone you know is starting their East Bay search, please share this video with them too. Thank you. Also, if you missed any part of the series, you can click part 1, 2, or 3 here, or here. If you'd like to learn a little bit more about me and the channel, go ahead and click here for that video.